Timing is essence when it comes to investing in shares of Aurora Cannabis, New York Stock Exchange, ACB. From one perspective, fiscal second quarter earnings look potentially bullish for Aurora Cannabis stock. The numbers at least are much better than they were the year before. Today, we will tell you 7 reasons why you should buy Aurora Cannabis stock now. Number 7, earnings are better. To look at Aurora earnings on a year-over-year basis, the report looks impressive. Spectacular even. Revenue rose 23%, with cannabis sales up 28%. Bear in mind that growth came despite a Canadian market that's still scuffling somewhat. The novel coronavirus has had an impact, and regulatory red tape slowed store openings as the legalized market was getting off the ground. Meanwhile, Aurora has essentially shuttered its wholesale business, where sales declined 90%. That's a reasonable move, given the glut of capacity across the industry. But wholesale alone had a negative impact of 4 percentage points on revenue growth, so the top line looks good. The bottom looks even better. In quarter 2 fiscal year 2020, Aurora posted an adjusted EBITDA earnings before interest, taxes, depreciation, and amortization loss of $69.9 million CAD. A year later, that loss narrowed all the way to just 16.8 million Canadian dollars, which includes about 4.7 million Canadian dollars of one-time expense. If you look at those numbers, this seems to be a company on the right path. Number 6, the turnaround plan. Aurora Cannabis has struggled to grow its business, and its investors have grown accustomed to seeing red on its bottom line. The company has failed to post an operating profit or even achieve profitability on an adjusted EBITDA basis. Share issues rather than cash-positive operating activities have been key to ensuring there is enough money flowing into the business to keep the lights on, and that's been frustrating for investors who continue to have their ownership diluted. But there is hope that after all the cost-cutting efforts and layoffs Aurora has been making over the past 12 months, its operations should be much leaner, meaner, and in better overall shape moving forward. Aurora has spent much of the past year raising capital and restructuring its business in an effort to contain its losses. The changes included cutting jobs, closing operations to consolidate production, and selling additional stock. The goals are to reduce expenses, more closely scrutinize capital expenditures, and improve the balance sheet en route to attaining profitability. Number 5, a look at the company's recent results. On February 11th, Aurora released its second quarter results for the period ending December 31st, 2020. The company did show progress on its bottom line, with adjusted earnings before interest, tax, debt, and amortization loss of 16.8 million Canadian dollars, falling sharply from the 57.9 million Canadian dollar loss that it posted in the first quarter for the period ending September 30th, 2020. This was despite revenues of 67.7 million Canadian dollars, showing no growth from the previous period, making it the third quarter in a row now in which the exact scenario has happened. However, Aurora anticipates more of an improvement in the EBITDA numbers in the third quarter after reductions to its headcount a few months ago. Those cost savings haven't been fully realized on the company's latest earnings report. Without sales growth and continuous losses, Aurora isn't giving investors much of a reason to invest in the business. While improving adjusted EBITDA is a positive, the company has pushed back its goal of breaking even multiple times. And although it does appear to be on the right track, investors need to remember that adjusted EBITDA is not a GAAP number, meaning that it isn't comparable from one business to another. The company effectively chooses what to include in the calculation. A closer look at the period shows that Aurora's operating loss was 47 million Canadian dollars, an increase of 11.2% from the 42.3 million Canadian dollar loss it incurred in quarter 1. The company did bring down its operating expenses by 4.5 million Canadian dollars or 6.6% from the previous quarter. However, that was offset with declining gross profits, as Aurora netted just 17.3 million Canadian dollars after cost of sales this past quarter, compared with 26.6 million Canadian dollars in quarter one. The company said the drop in those margins was a result of its scaling back production levels at Aurora Sky, in addition to a 1.8 million Canadian dollar increase in expenses that were related to net returns, price adjustments, and provisions. The challenge with marijuana companies is that there is often a lot of noise on their financials. That can make it difficult for investors to assess just how well a business is doing, and Aurora is no exception. While there were some positives to take away from the company's most recent quarterly performance, there may not be enough of an overall improvement to justify the stock's current valuation. Number 4, competitors are moving forward. While Aurora looks inward as it focuses on its transformation, competitors are looking outward for growth opportunities and attempting to establish frameworks in anticipation of possible legalization of marijuana at the federal level in the U.S. For example, in early November, fellow Canadian grower Aphria, NASDAQ, ATHA, purchased U.S.-based craft brewer Sweetwater Brewing, which sells the most popular hemp-flavored beer in the country. When it announced the deal, Aphria said that it provides a platform and infrastructure within the U.S. to enable it to access the U.S. market more quickly in the event of federal legalization. Aphria will also be merging with Tilray to create one of the largest cannabis companies in the world in terms of revenue. Canopy Growth has strong ties with American beverage giant Constellation Brands, New York Stock Exchange, STZ. Last year, Constellation added nearly $200 million to the $4 billion investment it originally made in Canopy Growth. Most recently, HEXO, New York Stock Exchange, HEXO, and Molson Coors announced that their joint venture, Trust CBD USA, is launching a new, non-alcoholic sparkling CBD-infused drink in Colorado. Number 3, a downsizing streak. During its 2020 fiscal year ended June 30th, Aurora's core business took a devastating blow, registering 3.3 billion Canadian dollars in net losses. During the span of 2017 to 2019, the company invested billions of dollars in state-of-the-art facilities to become the pot producer with the largest production volume in Canada. The only problem? There was never that much consumer demand in the first place, largely due to the black market being more resilient than legal sellers first anticipated. Last year, Aurora projected that it would be able to cultivate over 500,000 kilograms of dry cannabis by mid-2020 and post a lucrative profit. In reality, the company only ended up selling about 16,000 kilograms of dry cannabis per quarter. Facing steep operating losses, Aurora had to cut back its newly built cultivation sites, resulting in hefty write-downs and impairments. The troubled pot grower also paid substantial premiums for competitors that did not perform as expected. In early 2018, it paid 3.2 billion Canadian dollars to acquire MedRelief, a company that brought in only 43.6 million Canadian dollars in sales per year. Last February, Aurora laid off over 500 employees to restructure its spending. In June, it ended up cutting its sales, general and administrative staff by 25% and its production staff by 30%, while closing down 5 production sites. On November 30th, the company announced it was letting go an additional 30 workers and shutting down its Aurora Sun greenhouse. Aurora previously designed the site to grow over 230,000 kilograms of cannabis per year. That's not all. The company laid off another 200 employees on December 16th and reduced production capacity at its Aurora Sky facility by 75% to 25,000 kilograms per year. Overall, 2020 has been anything but good for Aurora's bottom line and far worse for investors. Nevertheless, the major downsizing efforts are paying off and should give investors some optimism. Number 2, light at the end of the tunnel. But after all this, now may actually be the best time for investors to start a position in Aurora. After all the aggressive cost-cutting initiatives, the company has scaled down its cultivation to about 67,500 kilograms per year, which is much more in line with market demand. During the first fiscal quarter of year 2021, ended September 30th, Aurora managed to bring down its operating losses to 42.3 million Canadian dollars from 77.8 million a year ago. The company's capital expenditures fell dramatically during the same period, from 106.8 million to 15.8 million Canadian dollars. Aurora's revenue has been mostly underperforming as the average selling price of cannabis has declined to $4.58 per gram from $5.68 per gram. There is no doubt that the Canadian market is becoming more and more saturated, as a result, more competitive. Aurora's revenue decreased by 8% year over year to 67.8 million Canadian dollars in quarter 1, 2021. The company, however, has had another shot at a return to growth with its new U.S. expansion plan. Back in May 2020, Aurora acquired cannabidiol CBD company Reliva, LLC for $40 million. Reliva CBD brands are among the top 2 in the U.S. The other belongs to Charlotte's Web and brings in approximately $10 million per year in revenue. Due to widespread support for the decriminalization or full legalization of cannabis on the federal level, the U.S. CBD market may scale to $12.3 billion in 2022 from about $5.1 billion in 2019. Number 1, why now is the time to buy? Stock in the cannabis sector have been on a wild ride since Canada legalized recreational marijuana use in October 2018. At first, there was a broad spike in prices as investors bid up the entire industry. But later, cannabis growers came back down to earth and stock moves started to be more closely tied to the specific situations of the individual companies. For those companies, a great deal hangs on the question of whether the U.S. will legalize marijuana at the federal level, and if so, when. Until that's answered, different operators are taking different paths. Aurora Cannabis has been a popular stock with retail investors, but the direction it's taken has not led to profitability, and it's now in the midst of a major course correction. The outcome of that will determine whether the stock becomes a winner. Aurora currently has $450 million Canadian cash on hand, which is about equal to its debt obligations. Besides that, the stock is only trading for about 4.3 times revenue or 0.9 times net assets. As long as the company continues to balance its Canadian business and focuses on pushing market share in the U.S., I think it is only a matter of time before it returns to growth. If you have waited to buy Aurora Cannabis stock on the dip, make it part of your portfolio in 2021. Do let us know in the comment, will you buy Aurora Cannabis stock? Please subscribe to the Stock Advisor. Thanks for watching.